Today, the property signs for the 1st of July 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at property buying intentions, forecasts for rate rises in Australia and New Zealand, rental property returns, and the expansion of a property behemoth. Many Aussies believe that right now is not the right time to buy property, but they plan to buy anyway, according to new data from National Australia Bank. Results of a NAB survey show that only 40% of respondents believed that now is the time to purchase real estate, but 15% still intend to buy a home in the next 12 months. Andy Kerr, Home Ownership Executive for NAB, said that the appetite among those looking to buy a home was at an all-time high, with young people the most eager to buy. While 18% of survey respondents overall were saving to buy a home, that figure is nearly 40% in the 18 to 29 year age group, according to The Australian. Despite the property price increases, first home buyers are going gangbusters, Kerr told NCA Newswire. April was our strongest month on record for mortgages, and we were up 87% for the first 4 months of the year compared to the same period last year. And that was up nearly 10% on the last 4 months of 2020. Regional markets saw skyrocketing activity last year as buyers fled cities seeking more land, causing prices in those areas to spike. So far in 2021, buyers have been seeking value, aided by increased flexibility in where they could work, Kerr said. First home buyers, though, were increasingly getting mortgages for inner city apartments as they returned to the CBD for work, at least for a few days a week. With a housing inventory shortage set to continue for some time, Kerr said, there was a fear of missing out, with prospective home buyers worried about being priced out of the market. And with interest rates still at record lows and government incentives getting great airplay, Kerr said the first home loan deposit scheme, with its next intake round beginning, is the nudge prospective property buyers need to dive into the market, according to The Australian. People are realising it's only marginally higher to buy a home than to rent, Kerr said. However, most first home buyers will have had a hard time finding affordable properties. The national mean price of residential dwellings is around $779,000, according to the ABS. The first home loan deposit scheme is raising property price caps effective today, something Kerr said was the right move. We're seeing a record growth in first home buyers, so I think they got it right, he said. First home buyers always tend to buy smaller places in potentially up-and-coming suburbs. Prospective home buyers might be wise to jump into the market despite skyrocketing prices. The current historically low mortgage rate may soon be a thing of the past. In fact, NAB announced on Wednesday that it was hiking its 2, 3 and 4 year fixed rates for owner-occupied loans by 0.1%, as we covered yesterday. While all 4 major banks still offer sub 2% 2-year fixed rates, Westpac is the only major still offering 1 and 3 year fixed rates below 2%. Which then begs the question, well, where will rates go? Well, last week, Westpac forecast RBA's tightening cycle would begin in the March quarter of 2023. They expect that the cycle will extend into 2024, with the cash rate peaking at 1.25% and lifting household debt servicing ratios back to the levels of 2020, when the last tightening cycle peaked. They expect that the bank will begin its tightening cycle in the first quarter of 2023 with a 0.15% lift in the cash rate. That's expected to be followed by 2 more increases in 2023 of 0.25%, each lifting the cash rate by year's end to 0.75%. Now, generally, they don't publish forecasts beyond 2023, but on this occasion, they said it was necessary to provide some guidance for the long-term views on the peak of the tightening cycle and the timing of that peak. And they said in providing those guidelines, they're relying on three key principles. The first, they do not envisage extreme inflation conditions during the cycle that would cause the RBA to need to overshoot policy. Instead, they expect that the inflation will remain within the 2 to 3% target band and the labour market will hold at around full employment. The second point is that whereas easing cycles can last for very long periods, for example from November 2011 to November 2020 was the last cycle, tightening cycles tend to be much more concentrated. Recent tightening cycles have been October 2009 to November 2010 and May 2006 to March 2008, November 1999 to August 2000. And third, the upside limit to Australia's tightening cycle is likely to be determined by the household sector's sensitivity to rising rates, given Australia's high levels of household debt. Using those broad guidelines, they are penciling in two further 0.25% rate increases in 2024, lifting the terminal rate, as they call it, to 1.25% by November 2024. That, of course, is for the cash rate. And that profile would satisfy each of those key principles. The pace of the rate increases, a total of 0.65% in 2023 and 0.5% in 2024, will be consistent, they say, with a measured move to normalise the rate structure at a time when the RBA is achieving its key objectives without jeopardising those objectives by overshooting policy. The cycle would span a little short of 2 years, broadly comparable with the length of previous tightening cycles. And based on a number of measures, they are using to address any stress levels of household borrowers, they believe that a cash rate limit of 1.25% is actually the limit above which interest rates would be contractory through their impact on household finances. The lift in the ratio in 2010 reflected the 175 basis point increases in the cash rate between October 2009 and November 2010, whereas the high servicing ratio in 2018 was being driven by rising debt levels as house prices boomed. An increase in the cash rate to 2.25%, they say, would see a damaging lift in servicing ratios nearing those pre-GFC peaks. 2 points to make here. The first is, of course, it does rather depend on what happens overseas with international financial markets and rates, because if rates move dramatically, for example, in the US, the banks would require additional rate rises to cover the additional costs of funds. And the second point is this. The RBA does seem to be coin-operated at the moment, and they will try and manage any moves relatively slowly, but external events could well overtake their carefully planned trajectory. So my view is that the Westpac story is a relatively conservative view of where rate rises might go. And I think we should be expecting perhaps more sooner. Elsewhere, CoreLogic says rent values continue to see strong growth, though gross rental yields are compressing. In the year to June, Australian rent values increased 6.6%. That's the strongest annual appreciation in rent since February 2009. The highest annual growth in rent values was across Darwin, where rents have increased 21.8% across the dwelling market, and that was followed by Perth at 16.7%. As with national home values, much of the increase in rental values may be associated with government stimulus, increased household savings, and a strong economic recovery from COVID restrictions. Rent value increases may also be a function of more subdued investor activity between late 2017 and mid-2020, with the resulting lower rental supply, as well as more demand deflecting towards rental markets in areas where home ownership has become less attainable due to affordability challenges. Even the worst affected rental market showed a more defined recovery trend through to June. Across Sydney, Rental units were down 1.1% over the year to June, and that was up from a recent trough in the annual growth rate of down 5.7% in the year to December 2020. In Melbourne, the annual change in unit rent values was down 6.4%, recovering slightly from the year-to-year declines of 8.2% in the 12 months to March. Due to property value increases outpacing rents, gross rental yields have compressed further through June. Across the combined capital cities, gross rental yields hit a record low 3.1%, and combined regional Australia has also seen a fresh record low of 4.5%. ABS housing figures to April showed a strong lift in investor financing since the start of the year, albeit of low levels. The return of investors to the Australian dwelling market may help to gradually ease rental conditions, they said, except net rental yields in apartments in Melbourne and Sydney in particular continue to languish, and vacancy rates remain high, and that won't change until borders open and migration flows return. Even then, the spare capacity will keep a lid on rental returns, and it still looks to me from my surveys as though more people are still looking to sell some of those investment properties, particularly in the high-rise sector. As of today, the 1st of July, franchise broker brand Mortgage Choice has officially joined the REA Group. The 29-year-old brokerage and aggregator, which suspended trading on the ASX on the 18th of June after receiving court approval for REA Group's $244 million acquisition, will continue to operate under its own brand through its network of over 380 franchises and over 500 mortgage brokers across Australia. Shares of Mortgage Choice will today receive a cash consideration of $1.95 per share as per the scheme of arrangement. The completion of REA's acquisition of Mortgage Choice expands the property listing group's reach into the mortgage space. REA's financial services business already owns franchise broking group Smartline, with the Mortgage Choice acquisition bringing the total number of brokers under the combined group to 940, with more than 720 franchises, over 40 lending partners, and a loan book of around $84 billion. REA Group CEO Owen Wilson commented he was delighted to welcome the Mortgage Choice team to REA. We're excited to be bringing together our two strong businesses. The combination of our Smartline and Mortgage Choice businesses will allow REA to accelerate our financial services strategy. We see considerable growth opportunities that will deliver increased value to our Smartline and Mortgage Choice broker network clients and business partners. We look forward to providing Australians with even greater choice and flexibility when it comes to catering for all their home financing needs. Mortgage Choice CEO Susan Mitchell said, "We are excited to be joining REA and the opportunity to leverage REA's vast consumer audience who turn to realestate.com.au for all their property and home financing options. And we look forward to evolving our combined service offerings to deliver superior value across all our stakeholder groups." And Smartline CEO Sam Boer added that the acquisition would provide the perfect ingredients to create a stronger value proposition and market-leading position. Bringing Mortgage Choice into the REA family will provide us with greater national broker coverage and strengthen our ability to help more Australians finance their next property. Over the coming months, REA and Mortgage Choice management teams will work to ensure a smooth transition and integration while delivering the same level of industry-leading service and to support its franchise network brokers, clients and business partners. And the REA Group has also recently acquired a 34% interest in home loan application and e-lodgement solution provider Simplegy Limited. The $15 million consideration, which has been funded from the group's existing cash reserves, will also see REA take 2 seats on the board of Simplegy, which provides e-lodgement solutions to lending and broker partners across Australia and New Zealand. The group notes that Simplegy's offering enables brokers to seamlessly lodge home loan applications directly into lenders' back-end systems and would further accelerate the group's financial services strategy, which is heavily focused on mortgages. Just the point to make here is that this organisation continues to expand its reach across the mortgage and property value chains. And of course, it's clearly looking to try and control the end-to-end experience. It'll be interesting to see how that plays out, but it looks to me as though the finance and property sector is evolving more and more in line with, say, the big supermarket sector. Small number of very large players with massive capability and not a lot else. Now, the Reserve Bank of New Zealand said in its most recent monetary policy statement that it was forecasting the beginning of rising of the official cash rate, currently of course 0.25% over there, in the second half of next year. But since then, the GDP result was much stronger than expected. And now economists at ANZ think that rates could even go higher later this year. They said the fact is that GDP growth of 1.6% in quarter one was far stronger than the Reserve Bank had expected. They'd expected a fall of 0.6%. Though the RBNZ doesn't publish forecasts at monetary policy reviews, the next is due out in the middle of July, the quarter one GDP data will inevitably lead to an upgrade to their estimate of how stretched the economy is and an earlier liftoff in their OCR forecast. The balance of risks has abruptly and firmly tilted from one potential regret, hiking too soon, to the other, hiking too late. The simple fact is there is now absolutely no reason to have the OCR at such extreme lows, and the sooner it rises, the better. A late scramble would imply more hikes faster, thereby increasing the odds of a hard landing for the housing market in particular. The Reserve Bank of New Zealand wanted to run the economy hot. They've achieved that in what's a mix of strong demand and constrained supply. The housing market is dangerously strong, they said. Households are spending freely. Businesses are employing and investing. Inflation is threatening to go well outside the top of the target band. The ANZ Business Outlook inflation expectation is to be above 2% and rising. Costs are soaring and the labour market is extremely tight. Unlike some central banks, the RBNZ isn't afraid to change its mind when the facts change, and good on them. While downside risk absolutely could still eventuate, the more pertinent risk here is now that we're seeing a higher official cash rate before the year is out. And they concluded that as New Zealand's economy is running so hot, the RBNZ's path of least regret is morphing into tightening sooner to head off excesses rather than overstimulating to avoid slipping into the economic abyss. Thus, a November 2021 RBNZ hike is now, quote, a real possibility. Now, this is quite important because, in a way, the RBNZ is further down the curve relative to many other central banks. And if it's true that interest rate rises are going to come sooner, that's going to have a quite profound impact on household budgets. As I discussed, the Westpac view is they can't raise them very much because if they did, that would put huge pressure on household debt servicing ratios. The fact is, even small rises will have significant issues. My mortgage stress in Australia, for example, shows that a raise of even 1% would be pretty disastrous for many people. So it'll be interesting to see how central banks manage this rather complex situation. They need to raise rates to slow the economy a little, but if they raise rates, they could kill the economy. Not a good position to be in. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.